What if that one price prediction you scrolled past last week is the very thing that guarantees you look back in 5 years and realize you missed the single greatest wealth transfer of your lifetimes? This insidious fear, the dread that the world is moving too fast and leaving you behind, is not an accident. It is the fuel powering the entire frenzy. We are bombarded daily with headlines promising exponential wealth, Bitcoin to $100 million, the next 100x AI stock, or the undiscovered land boom. But the real power isn't in the asset. It's in the story of the Lamborghini effect. You know them, the friend, the nephew, or the coworker who bought early and, seemingly overnight, transformed an ordinary bank account into 7 figures. This narrative transforms financial discipline into a foolish handicap. It suggests that if you are following the old rules of value, cash flow, and rational investing, you are simply too slow, too risk-averse, and too foolish to keep up with this digitally accelerated world. The great risk flip, the architects of hype, the influencers, the self-proclaimed digital prophets, and the early whales successfully re-engineer your sense of risk. They present the most compelling arguments not as possibilities, but as inevitabilities. The scarcity trap. They highlight the mathematical scarcity of the asset, a hard limit of 21 million coins that no central bank can inflate away, and contrast it directly with the reckless trillion-dollar printing presses of governments. This creates a powerful, logical fear of the conventional, the idea that your savings in traditional currency are silently being eroded. The risky digital asset suddenly becomes the only defensive play left. The legitimacy shield. They neutralize your skepticism by showcasing institutional backings. The 60 billion wager by Michael Saylor, or the launch of massive ETFs by BlackRock, the biggest asset manager on earth. Their signal is clear: if the smart money is buying, the price must be going up. You must buy now. The chilling rehookbut here is the moment that should send a chill down your spine. The smart people on this side, while compelling, are almost always talking about price appreciations, not production of actual value. They are using history, comparing this moment to the early internet, to trick you into accepting high risks. They dazzle you with the technological promise of DeFi and smart contracts, but they immediately translate that intellectual curiosity into a purchase based on one simple, fatal belief: number go up and everyone's buying it. This module establishes the stakes. A high-pressure environment where your greatest fear, being left behind, is weaponized against your basic financial prudence. The real question is, before you click buy, are you ready to understand the single, fundamental psychological trap that these architects build? It has nothing to do with Bitcoin and everything to do with your brains. That's the real trap we break down in Module 2. If you bought this asset today, and I told you that you could not sell it, trade it, or cash out for 20 years, would you still buy it? Your gut reaction to that single, critical question tells you everything about whether you are investing or speculating. This distinction is the difference between building lasting wealth and gambling it away, and it all comes down to the concept of intrinsic value. When a true investor buys a stock, they are buying a piece of a productive business. That business owns real assets, employs people, and creates products or services that others pay for. It generates revenue and, ideally, profits that can be reinvested to grow the operation or return to shareholders. The sheer excitement of traditional investing is rooted in compounding. Think of it this way: if you buy a farm, it produces crops every year. You sell those crops to buy more land or better equipment. The farm's intrinsic value increases because it produces more output. It's not just because someone else is willing to pay more for the land itself. You own a goose that lays golden eggs. The brutal truth: nothing. Zero. Now, consider the asset the hype demands you buy. What does it produce? I know you hear about decentralized finance and smart contracts, but those are tools, not value production. The brutal, simple answer to what the asset produces is nothing. Zero. You buy it today at an inflated price, hoping that a greater fool tomorrow, next month, or next year will pay you more for it. But in that entire interim period, the asset itself hasn't created a single penny of tangible value. As Charlie Munger famously warned, you're choosing between owning that productive goose and owning a gold cube you just hope to sell for a higher price. The illusion of backing even the argument for digital gold falls apart under scrutiny. Physical gold suffers from the same fundamental problem. Its value is largely psychological and based on the hope of future greater price, which is why I've been consistent about both. The 118 trillion valuation of all mined gold, compared to the same value in productive companies and farmland, is staggering. The companies generate trillions in wealth over a century, while the gold cube just sits there having produced nothing. The true rehook is this: traditional fiat dollars, for all their flaws, are backed by the utility of the U.S. government accepting them for taxes and using them to settle all debts. That provides a baseline demand. This speculative asset has no such backing. Its value is entirely dependent on the next person in line being more enthusiastic than you are. This confusion between a productive asset and a speculative token is the engine of the hype cycles. The technology is revolutionary, yes, but does a revolutionary concept guarantee you a profit, or does it merely guarantee an entirely new, efficient way to lose all your money? This is the crucial separation that the hype machine desperately tries to blur. They lure you into a false sense of excitement, making you believe that simply being early to the next great innovation is enough to win. They constantly cite blockchain, smart contracts, and decentralized finance, and they are correct that this technology might revolutionize everything from supply chains to healthcare. But here is the single, costly trap. You do not need to own this specific asset to benefit from that technology. The fear you must overcome is being right about the technologies, but losing your capital because you chose the wrong investment vehicle. This is precisely what happened during the dot-com bubble. The internet was clearly revolutionary, yet the vast majority of people who invested in internet stocks during that bubble lost everything. Never confuse the map for the treasure. The volatility as a weapon. The clearest, most painful proof of this disconnect is the recent reality of liquidation sweeps. When the market turns, the forced closures of leverage positions create massive, cascading crashes that wipe out billions of dollars in hours. This is the difference between a productive asset, like a farm, and a highly speculative one. The massive drop we saw from 69,000 to under 16,000, a stunning 70% decline, is not a mere market fluctuation. It is the brutal mechanism by which wealth is rapidly transferred from the late leveraged speculator to the large, disciplined buyer. The ultimate rehook ownership vests utility. This brings us to the ultimate point. You can be 100% right about the technology and still lose all your money by paying too much. Just as MySpace had the first mover advantage and BlackBerry dominated early smartphones. Being first does not guarantee you will be the ultimate winner. The real fortunes were made by companies like Amazon, Google, and Netflix, which use the internet to deliver better products and services, not by the domain speculators who lost everything. The same will be true with this new technology. The real money will be made by the existing or future companies that utilize the technology to create more value in their own businesses. Owning the token today at its current price only gives you exposure to its extreme, sentiment-driven volatility. It doesn't give you ownership of the fundamental innovation happening in the backgrounds. The architects of hype want you focused on the price chart, so you don't look at the true distribution of the asset. In Module 4, we're going to expose the final, most manipulative tactics, how they fake adoption, and why the sheer concentration of ownership means that the wealth transfer is already over for most people watching this video. The hype machine promises that the old rules of value no longer matter, but what terrifying historical parallel guarantees that following the crowd today leads to utter financial ruin tomorrow? This module triggers the deepest, most universal fear in finance, the repeating cycle of history. The ultimate reassurance of the speculators is, this time is different, but the only immutable truth is that speculation disconnected from intrinsic productivity always falls back to earth. We must look back at the grandest bubbles to see your present day reflection. The .com staked the .com bubble in March 2000. The Nasdaq peaked, driven by the revolutionary, decentralized promise of the internet, just like the promise of blockchain technology today. But by October 2002, the Nasdaq had crashed a staggering 78%, turning companies valued in the billions into worthless footnotes overnight. Companies like Pets.com, which spent a fortune on Super Bowl ads, went bankrupt 9 months later. The excitement of that era, the belief in network effects and eyeballs, perfectly mirrors the digital gold and sound money arguments we hear now. But here is the painful rehook of history. Even if you had perfect foresight and knew which companies would survive, you still could have lost a fortune. Cisco was a great surviving company, yet investors who bought its stock at the peak in 2000 had to wait 2 decades, and arguably the stock has never truly recovered its all-time high price. Amazon dropped a terrifying 955% from its peak. This historical evidence confronts your insecurity head on. Being right about the technology does not prevent you from being liquidated by the price. The belief that you must buy now is the single most destructive lesson carried over from every past bubble. The granddaddy of all hype tulip mania, but the most vivid, compelling parallel. The granddaddy of all bubbles is tulip mania in 1/10 of the century Holland. At the peak, a single tulip bulb could cost more than a luxurious canal side house. People traded their farms and entire livelihoods, driven by the simple idea that the next person would pay even more. The justification was the same as today. The bulbs were exotic, beautiful, and truly scarce. You couldn't just plant more overnight. Scarcity was weaponized. When the bubble popped, the rare tulips that had been worth a house became utterly worthless, and the flowers themselves now sell for a few dollars at any garden store. Every bubble shares the same anatomy, a small grain of truth. Early adopters making quick money, creating FOMO, sophisticated sounding justifications, and the complete dismissal of traditional metrics like earnings and cash flow. The final, terrifying certainty is that the bubble always pops. The collapse is inevitable. The only question for you today is this: who are the financial architects who profit from the confusion? And how do you build a strategy to ensure you are not the victim when the music stops? In our final module, we reveal the 2-part solution for insulating your portfolio from the madness. After witnessing the terrifying pattern of bubbles, the devastating risk of liquidation, and the historical cost of paying too much, what critical principle can you apply right now to protect your capital and ensure you sleep well at night? The answer lies in the cornerstone of value investing, the margin of safety. My teacher, Benjamin Graham, taught me that you want to buy assets for less than they are worth. This creates a cushion, so even if your analysis is wrong, you still have a protective barrier against catastrophic loss. For a productive business, we can calculate that intrinsic value based on its earnings and assets. But for an asset that produces nothing, its intrinsic value is 0. You can't buy 0 for less than 0. Therefore, the terrifying reality of today's speculative prices is that there is no margin of safety. You are paying full speculation price and simply hoping the next buyer is more enthusiastic. The ultimate insecurities. What if I'm wrong? This leads us to the one thought that keeps every sensible investor up at night. What if I'm wrong? What if the asset goes to $1 million and I miss out on life-changing money? I have felt that fear of missing out, or FOMO, countless times. But I've learned this truth every time I've acted on FOMO. I've regretted it. And every time I've ignored it and stuck to my principles, I've been glad I did. The assets narrative requires everything to go right, continued adoption, no serious technical flaws, no major government crackdowns, and a constant, endless supply of new buyers. The productive assets narrative, however, requires only what has been true for centuries. People will keep needing fundamental goods and services like soft drinks, reliable health care, and basic infrastructure. The final choice production vs. Poor chance here is the ultimate thought experiment for your final choice. Imagine you have money to invest. Choice A. Buy the speculative asset that either goes to $1 million or goes to 0 in the next 10 years, but produces no income in the interim. you are entirely dependent on market timing. Choice B. Buy a diversified portfolio of rock-solid businesses like Coca-Cola, Johnson & Johnson, and others that collect dividends every quarter, grow their earnings, and expand their markets. Which choice gives you better odds of building lasting generational wealth, lets you sleep well at night, and doesn't require you to become an expert in cryptography or market timing? The volatility of speculation is not an opportunity. It's a form of financial Russian roulette. While it might make a few architects of hype rich, it will make far more people poor. The exciting truth is that the boring stuff works. My wealth is built on businesses that make products people need year after year, and that is why I sleep like a baby every night. The goal is not to get rich quickly, but to get rich inevitably. Remember, when the tide of speculation inevitably goes out, you want to ensure you haven't been swimming naked. Stick to the margin of safety.